it's going to return 15%. Believe me, I've seen it all over the internet, and it is so far from the truth. People are being hurt by this. Another day, another shitty IUL in my inbox. So let's go check it out. They just don't stop coming, do they, Pigeon? Today's IUL is from National Life Group, which is a shame because National Life Group is a really good company and their living benefits are awesome. But this policy is a mess. Crazy what a hairbrush, a new shirt, a little bit of eyebrow gel can do, huh? Let's go. Welcome to my office. And here we are. National Life Group Flex Life Indexed Universal Life Insurance Policy. The client is a male who is 28 years old, standard non-tobacco health rating, and they were contributing $124.83 a month and had a $200,000 death benefit over their head. Now, like I already mentioned, the policy does have really good living benefits. So if we come down here, we're going to see that there is a terminal illness, chronic illness, and critical illness rider, as well as a critical injury rider and a Alzheimer's disease benefit, which is wonderful. But as you know, I have already talked to this client. I asked them first thing, why did you purchase this policy? What was their response? I purchased it for the cash value and the access to the loans, right? The policy loan provision, not for the living benefits, not for the death benefit. So if it was the opposite, maybe this policy would have been fine, but it wasn't. So we keep going. Here are the guidelines in this policy, our premium guidelines, which tell us the max contribution per year and the minimum contribution per year. Well, if we take the 124 and 83 times 12, that is $14.97 and 96 cents. Now, the Guideline Level Annual Premium, the Guideline Level Premium, is the max contribution for the life of the policy. Well, that number is $24.73. Almost $1,000 more than what the client is contributing. The next premium guideline that we look at is the target premium. Why? Because the target premium is the minimum contribution amount per year that will keep the policy in force and not result in the insurance carrier asking the client for more money later on. It's like the goal amount. What is the target premium? Oh, it's $14.98. It's 4 cents more than what the client is contributing. Why? So that's where this random $14.97.96 came from, or excuse me, the $124.83 a month. There was no reason for the premium to be this random number. Might as well have been $125 to keep the policy in perfect standing for this person's life, and the agent couldn't even do that. Now, there are a couple other minimum premiums listed here. The minimum premium will keep the policy in force. It won't guarantee much, and you will be forced to contribute more later. The death benefit protection premium will guarantee the death benefit coverage for a specific amount of time. Neither of these premium amounts are going to build a cash value. This one would. Now, there's also the max non-mech premium, which is $96.21. That number is the max contribution for the first few years of the policy. It's also referred to as the 7-pay. Much, much higher than what the client is contributing. So if this tells you anything about how these projections are going to look, it's not going to be good. And here are the index options and where the money has been allocated to. We got 100% of the money in what's called the U.S. Pacesetter Index. It doesn't have a cap. It has a higher participation rate, which we'll go over, but 100% of it is in this index. We didn't want to use the S&P 500 life agent? Why? Why not? Is it because the Pacesetter is going to let you run the numbers at a 6.42% annual return, whereas the S&P 500 is only going to let you run the numbers at a 5.97 or a 4.5 or a 4.8? Could that be why you're using it? let's go check out the historical performance of these indexes. And real quick, here's the pay setter. It doesn't have a cap. It's actually guaranteed not to have a cap. The current participation rate is 215%, but the guaranteed participation rate is 50. Nice. The S&P has a cap of 9.25, 105% participation, guaranteed to be 100% participation. We have other S&P 500 indexes as well. Now, let's go look at that historical performance. Here is the pay setter and what it actually returned, and then here is what the IUL with National Life Group would have received, okay? Now, if we go down, because what's really important here is the last few years, because National Life Group has only been using this index for the last 3 years, I believe, and this is actually an old policy. So the last year in 2022 is the only year that the IUL has actually had the U.S. pay setter available. And what did it do that year? It went negative. And so we got 0%. Now, you can see that it has had really good years in the past, right? But let's just look at the average returns of this index, shall we? Because the 5-year average return for the pay setter is 2.5%. The 10-year average return is 3.5%. The 20-year average is 5.9%. And the participation rate turns these returns into double digits. There's also a bonus. It's a not guaranteed bonus. Bonus is not guaranteed. But the problem with this is that National Life Group can change the participation rate at any time, all the way down to 50%. The average returns of this index are not good. And we don't actually have any history of National Life Group crediting their IUL utilizing the pay setter. So this is a bunch of crap on their illustration. Sorry, National Life Group. I love your living benefits. I think you're a good company, but this is misleading. And the agents are looking at this 20-year average and saying, look, it's going to return 15%. Believe me, I've seen it all over the internet. And it is so far from the truth. People are being hurt by this. Like, it's really not okay that insurance carriers are able to do things like this. Anyway, we could have just used the S&P 500. It's this one. The S&P 500 has averaged 7.5, 10.4 over the last 10 years, 7.16 over the last 20, which results in these 5 to 6% annual returns, which is very realistic of an IUL. It's not a bad thing to have an IUL return 5 to 6%. It's really not. It doesn't have to be a big deal. We don't need to see these crazy returns inside of a life insurance policy. We want to accurately explain to our clients how these policies work and make sure that they are expecting something realistic and are not going to be let down later on in the future after they've already given over all of this money into the policy, hoping to build a cash value and earn interest. Anyway, I digress. Here we have the guaranteed numbers, okay? There is a guarantee of 2%, right? They're also showing maximum monthly charges. Fine, no problem. There's our $14.97 going into the policy each year. I told you the client was 28 years old. Well, after year 1, the total value of the policy, which is called the accumulated value, is $666. There is no cash value for 4 years, but we have that $200,000 death benefit, and look at that, it's a level death benefit. This is not a death benefit focused, living benefit focused purchase for this client, but this policy is absolutely set up to be a death benefit focused policy. If we keep going, 10 years go by, 15 grand has been contributed. We have 6,500, not even half of the money. This is guaranteed, so it's like our worst case scenario, But still, 20 years later, 30 grand has gone in. We have $13,000 inside the cash value. Not great. When was the surrender period over? I love to look for that. It was over by year 11. So that is a good thing for you guys to know about National Life Group. Their surrender period is only 10 years. Great. Awesome. If we keep going, when's the policy going to lapse? Let's be for real. At age 73, when we're still contributing money, the policy is going to lapse. So because the insured person was only paying a little bit less than the target premium, no interest is being earned, they could pay for this policy for as long as they could, and then the policy was going to lapse no matter what. That's the guarantee. Pay for this policy every year, contribute 68 grand, and then we're going to give you nothing. Woohoo! So let's look at the non-guaranteed numbers. We're going to have an alternate return of 3%, and we're also going to see that 6.42% average return. So we know that our money is going in about $1,500 a year. At a 3% return, we still have 3 years of zeros. At a 6.42% return, we still have 3 years of zero. Man, let's look at the 20-year return. Let's just scroll down a bit. 30,000 went in. Over here, we have 35. So what happened over there? 15 grand turned into 10,000. It took us around 15 years to really break even on this policy. And if we scroll down, let's look at the next 30 years, 44, almost 45 grand has gone in. Now we have 81,000. Okay. At a 3% return, we would be broken even right there at 30 years. If we keep going, we're going to pay for this policy forever. We're not going to stop paying for this policy. Great. So now we're 67 years old. We've put in 60 grand. We have 170,000. The death benefit started going up. So that is something worth mentioning. When you have a level death benefit option and you see the death benefit actually increase, that means that enough money has been accumulated inside the policy that the death benefit actually has to increase to remain a genuine life insurance policy and not become a modified endowment contract. So that does mean that the policy's grown enough and accumulated enough that the death benefit is hitting those tax limits. So, okay. But I'm pretty sure, I know, that the client did not want to pay for this policy until they were 77. I mean, at that point, they do have $344,000. Death benefit is rising rapidly at this point. Let's keep going. They're going to show the 3% alternate return is going to lapse no matter what after paying, almost a little over 90 grand. Be 89 years old. We have no money. But we're going to keep paying for this policy forever. 97 years old, 104 grand went in. Now, if we had that 6.42% return, the death benefit for the beneficiary would have been 1.2 mil. Okay, not bad. Just wasn't the point of the purchase, right? And this is hypothetical based on an index with no real data to show us. And perfect performance throughout the policy's life of an average of 6.42%. It's rough, honestly. It maybe doesn't look bad. It looks like hey, this is a permanent insurance policy. I'm only paying $125 a month. I'm gonna eventually get more than 200 grand of death benefit coverage for my beneficiary, and I don't have to worry about losing my insurance coverage. But is that really what's happening here? There's so many ways for this plan to fail that there's just no way I could confidently tell anyone that it's gonna be okay, maybe. No, I couldn't even say it because I can't even say it right now as a pretend. So that is that. I'm tired of doing these policy reviews. Honestly, I hate telling people that their policy sucks. So if you're a life insurance agent and you need this training because you're not getting it anywhere else, then you need to join LifeWiZE. LifeWiZE is an all-in-one training platform where you can get training on IULs from basic to advanced. Join us today at lifewize.io. I'll put all the information in the caption. Now let's get back into it because I'm about to show you how I would have set this policy up the right way. Same National Life Group, Flex Life, IUL, 28-year-old male, $124.83 being contributed a month, standard non-tobacco health rating. Big difference is the client's death benefit is going to be $50,000 compared to $200,000 because we are now setting this policy up to be max funded with the minimum amount of death benefit. So, yes, we're getting less coverage, but again, that was the whole point, was that the cash value was the focus and the reason for purchasing the policy. So let's go check out how those premium guidelines changed. So we remember that the client is contributing $14.97 a year, right? About $125 a month. Now, their guideline level premium is $18.26, which still not max funded completely, but the target premium, $374.50. Let's just remind ourselves what the old policy said. $24.73 was the max contribution and $14.98 was the target premium. So the agent would have made around $1,400, whereas if they set it up correctly, they should have made around $300. This is way more flexibility for the client. They're almost fully funding it, and they're young enough that, hey, you got an extra $350 of funding room each year so that you can make this policy's cash value grow a little bit more. Now, even the 7-pay is down to $2,405 compared to $9,600 a year. And those minimums are so low, it's ridiculous. $302 a year to protect the death benefit long term. Like, this is wildly different than what we just saw. Wildly different. Anyway, now let's talk about the index allocations that I would have used with a National Life Group policy. Here we are. I would have used the fixed term strategy where we're getting 3% guaranteed on 20% of the money, no matter what. All of the indexes crash, great. We're still earning 3% on 20% of our money. I would have put 50% into that S&P with a cap, right, of 9.25%. 50% of the money in the S&P, and I would have used another S&P and put 30% there, the remaining money. Why? Because this one has a 1% floor. So once again, the S&P 500 crashes, well, 20% is going to earn 3%, and 30% is going to earn 1% no matter what. So this is what I would do. You don't have to do exactly what I do. I'm not perfect, but I like to be conservative. I like to use historical index options, and I like for my clients to be earning interest and feel confident that they're going to be consistently earning interest no matter what. Here are guaranteed values. Our guaranteed values are showing that our money goes in, our death benefit increases because I'm using an increasing death benefit option, and year one, the value of the policy is already $1,177, and we already have $366 in the cash value. By year 10, almost 15 grand has gone in. They're showing us guaranteed to have almost 13,000 earning interest and 12,644 inside the cash value. Let's just go back to the other one and remind ourselves of what those guaranteed numbers looked like. Here are the guarantees on the original. 4 years of no cash value. After 10 years, 15 grand went in, and we had 6,500 available and 6,800 earning interest. Very huge difference. Of course, this policy has much more death benefit, right? But I sound like a broken record. That wasn't the point of purchasing. After 20 years, 30 grand turned into 13,000. What does the new illustration show? 30 grand turns into 27,700. $27,700. Almost all of our money is guaranteed to be there. If we keep going, is this policy going to lapse? No, it's not. And guess what? I even stopped contributing money after age 65. And this hashtag mark is telling you that I leveled out the death benefit so that it would stop increasing. So we're sitting with $108,000 and the policy is still going on. Now, it does show that it lapsed at 89. Okay. We didn't put any more money into the policy. It was a total of $56,000. We didn't pull any money out either, but it still lasted until age 89. So at 88, the client still would have had $108,000, and that was just the guaranteed numbers. Those are just the guaranteed numbers. So let's go look at the non-guaranteed numbers and see how that compares. Here we are. We still have a 3% return, and now these non-guaranteed numbers are showing a 5.05% return. But regardless, after 10 years, 15 grand goes in, we have more than 15 grand. Our death benefit is increasing, great. Let's look at 20 years, almost 30 grand goes in, now we have 41,000. Let's look at another 10 years, 45,000 goes in, we have $84,000. Now, no more money goes in after that, so it's a total contribution of $57,000. That turned into $154,000 with $181,000 death benefit, and all of the numbers, our cash value and our death benefit, keep going up. No, I didn't take out any money. It's still a very small policy, but if we keep scrolling down, 102 years old, 56,000 is all that was contributed. The beneficiary would have gotten $890,000. At 97, $684,000 from a $56,000 contribution. Just because an IUL is small doesn't mean that it has no value, right? Just because the IUL is not bringing an income or providing an income doesn't mean it doesn't have value. This is a permanent death benefit policy still, but the client could have absolutely taken money out of their policy during retirement if they needed to. There was plenty of money over here for an expense or an emergency, for healthcare costs, right? For anything. If you found this video educational, insightful, make sure you subscribe to my channel. Don't miss out on any of my upcoming videos, and send this video to your life insurance friends who maybe need a little bit of education. Otherwise, bye!